As SMC traders, we look at these areas and anticipate this kind of market behaviour. But this does not mean SMC traders are immune to being induced like this, and we will cover this later on. Hello and welcome to SMC FX. In today's video we're going to cover inducement. So what is inducement? Inducement is when price has been manipulated in such a way that it creates liquidity in areas that banks want to move price to and from. In the example to the left, you can see that an order block or a demand zone was formed by an impulsive move that broke structure and then price ranged for a little bit. The dollar symbol indicates where liquidity most likely lies and where banks will likely want to manipulate price before pushing upwards. Once price has swept the liquidity at the bottom of the range, it can then continue its move to the upside. Points 1 and 2 are likely areas where the average trader will be looking to buy or sell. Now many traders would look at this and call it a stop punt, and they would be correct. Large institutions, they do hunt stop losses as the liquidity helps fuel their intended moves. As SMC traders, we look at these areas and anticipate this kind of market behaviour. But this does not mean SMC traders are immune to being induced like this, and we will cover this later on. So here we have a chart example of inducement. Now this was actually a trade that was taken by myself on the 4th of April, and this was also sent into our community, and it was also posted on Instagram Live. Now what we've got going on here, we've got our our supply zone here, and then we've got our break of structure. Now we've got an impulsive movement that has also left some imbalance behind. Now what we've then got is this push up from here. We've also created another demand zone here which has broken this piece of structure, okay, but overall the current price action is bearish, so we're looking for our short. Now we swept liquidity to the top of the range here. We've then tapped into our supply zone, and the target was this newly formed demand zone. So in this example we will look at how SMC traders can also fall into the inducement trap. Here we have a simple chock or a change of character entry model. Many new SMC traders and also some experienced traders will see a chock and just dive straight into a trade. But what some fail to do is read the charts and identify whether they are being induced by the large institutions. Now after all, the large institutions, they know how we trade, so why wouldn't they target us as well? So here we can see the impatient SMC trader would have been stopped out of the first chock. Now as you can see to the left, we've still got the same chock entry model that we had in the previous slide, and we've got a higher time frame demand zone further below. By waiting for the higher time frame demand to be mitigated, we increase our chances of the trade working in our favour. So here's an example of a chock that didn't work. So we've got this small little bullish leg just going on here. We've then got a reaction off this zone here and here, as you can see. We then had our breaker structure to the top side here, and then we then had this breaker structure down here, which then confirms this movement as a chock. Now because we've still got an unmitigated POI or a supply zone up here, we've initiated the chock. However, we've then continued pushing up, grabbing this liquidity, mitigating this supply zone before continuing back down. And this is a good example of where some inexperienced smart money traders could fall for the trap.